There are times when you're the fortunate recipient of a financial windfall. Maybe it's an inheritance or you just liquidated a piece of property. Whatever the circumstances are, you have a very important decision to make. That decision is, where do you put all that money? You need a place where that money will be safe and not at risk. You also need a place where it has the opportunity to grow. This video is about an unconventional option that most people just don't know about. Hi, I'm Tony Manganello, and since 1995, my business partner John Commuta and I have helped over 3 million people make smart decisions with their money. And this is a video of a training I did for our team where I was teaching them how this option works and why it's one that should seriously be considered where large sums of money are concerned. It's called the Modified Endowment Contract, or MEC. You're about to learn why a MEC can be a great place for that financial windfall. Heck, it's a MEC. When we talk about this type of life insurance contract, many times what we're dealing with is an environment where we kind of talk about the MEC in terms like, you don't want one. Okay. So while we work to avoid MECs in general, it doesn't necessarily mean that they're never applicable, that they don't have a place. And we're going to talk about that and give you an idea of why they are good options in some circumstances. And at the same time, outline why in some cases we are trying to avoid, or I should say, in most cases, we're trying to avoid creating a MEC. It's the tax implications that are different. But when you're done watching this little presentation, you'll have a good idea of why a MEC isn't always a bad idea. So moving on, the Modified Endowment Contract, a MEC, MEC stands for Modified Endowment Contract. And, essentially what happened is before the 80s, rich folks would go to their advisors and say, hey, I got an extra $50,000 or $100,000 a year, or I've got an extra $250,000 and I don't know where to put it. And they would say, the advisor would say, hey, you know what? Let's put it in a life insurance contract. And the rich guy would be like, what the heck do I need a life insurance contract for? I'm rich. To which the advisor would turn around and say, don't worry about the life insurance portion. We're just going to get the minimum required death benefit to start your contract. Then we're going to stuff the rest of the cash inside the cash value of the contract, because you know what? Life insurance contracts are wonderful tax havens. Okay, so that's what was going on before, I should say, up until the 80s. And it would change where these two tax acts that were created was DEFRA, the Deficit Reduction Act of 1984, and TAMRA, the Technical and Miscellaneous Act of 1988. Very interesting terms. Leave it to our Congress to make things complicated. So DEFRA, or the Deficit Reduction Act of 1984, this is what introduced the guideline premium test to determine if an insurance product was taxable. And when we put together contracts, this is the formula, or one of the formulas that are used to make sure that contracts that we put together for the typical private family banking client are not going to MEC on them. And that means they're going to have all the tax advantages that they're looking for. The TAMRA Act, which is the Technical and Miscellaneous. I love miscellaneous. What does that mean? How's that? It's like they just stuffed whatever they wanted to in this act. But this was the guideline premium test to determine if the product was taxable. And it was more along the lines of the amount of death benefit on top of the cash value and how it correlated. So up until that point, rich folks were taking advantage of the tax shelters offered by life insurance contracts, and Wall Street wasn't having it. It's been said that there was a time where in the Wall Street Journal and other investment type publications, insurance guys were putting out ads saying, hey, let's check out this tax haven. And they were trying to find rich people to put into these contracts, because up until the 1980s, you could stuff almost any amount of cash value into a life insurance contract, and Doing that would give that cash value all the tax advantages life insurance contracts offered. So Wall Street found out that people were taking their market. Okay, so people with lots of money, Wall Street wants those people or I should say, wanted those people and still wants those people putting their money into stocks, bonds, mutual funds, what have you. And so when they found out that the tax haven that life insurance offered, they couldn't really compete with that. That's when the rubber met the road with regard to actions being taken with regard to Congress passing the laws in the 80s. Okay, so I've been kind of told that by a couple people in the industry. I've never been able to really find any information to support that, but I'm sure it's there if you look deep enough. And it makes sense because let's face it, um, the amount of money it would take to lobby to make these changes is considerable, and Wall Street has it. And they weren't having the idea of people trying to take their business away. All right. So, but when it comes to a MEC, when we build a private family bank, avoiding a MEC, when we're working with a client to build cash value over a period of time, it has significant tax advantages. We know that we basically tell people when it comes to private family bank, we're taking money from tax me now to tax me never, right? So when we're building a contract or the typical private family banking contract, this is why we do it, because of the tax me never status, the tax me never advantage. But what about a client who has a windfall of money? Let's say they got an investment or some type of settlement or some type of big chunk of money. Maybe they liquidated a piece of property and they want access to it soon, within 12 to 24 months. They don't want to wait on putting the money in a longer term, multiple year type of drip situation, which we could do, which would be a different story. But when somebody doesn't want to have to wait to have access to the funds and they have a lump sum of money and they really don't plan on making ongoing contributions or payments into a contract. Typically, we all know that if we have somebody who wants to build a contract over a period of time and they want to put money in on a monthly or annual basis, whatever payment modality they want to choose, payment mode, excuse me, then we can typically find a way to fit lump sums of money into those contracts. But if they don't want to put money in an ongoing fashion, what are their alternatives? Where would they put the money? In a bank CD with their pitiful interest rates, a money market with slightly less pitiful interest rates, or the market or mutual funds where capital preservation and reliability come into question. And then when it comes to mutual funds and even some stocks, you've got loads or commissions and fees to pay. So these are typically the types of alternatives available to somebody who has a lump sum of money, 50, 75, $100,000. These lump sums cannot be paid into things like IRA, SEPs, or typically any kind of qualified plan because it would exceed the limit that each of these plans would otherwise have. These are not options for lump sums of money. So what do you do? So the MEC interest rates are significantly higher than those offered by banks or CDs or money markets, right? The capital preservation is higher than banks and much more higher than mutual funds. And when it comes to banks, we've said this before, but a bank can lend up to $10 for every dollar that's on deposit. So they're leveraged pretty highly, which means that when you put your money into a bank CD, without getting into too much detail, you're essentially giving the money to the bank and they're making a credit into your account saying that they owe you that money because it has to be their money to lend. And then they take that money and they lend it out to as much as 10 to 1 with regard to leveraging it. So banks are leveraged 10 to 1 for every dollar on deposit, every dollar you put in that account on deposit. Okay, so the capital preservation of a MEC is much higher because it's a life insurance contract. And it's going to have all of the benefits of security that life insurance contracts have. Typically, life insurance companies have to be a 1-to-1 ratio of solvency. They have to be able to demonstrate that they can pay out the death benefits should they need to. So the capital preservation of a MEC, which is a life insurance contract, is higher than a bank, even though the bank has FDIC insurance. And money markets, well, typically those are pretty stable, but again, pitiful or slightly less pitiful interest rates. And when it comes to mutual funds and stock in the market in general, we know that there's not as much reliability there that most people would want. If you got a lump sum of money, you want to make sure that you're protecting it as much as you possibly can. And so that's where a MEC comes in, because the reliability is significantly higher than mutual funds or market options. And then there are fees on top of it immediately, that when you look at these options, the MEC has a fee as well. And we're going to look at that in a minute. As you know, when it comes to a mutual fund, usually you got a 4, 5, or 6% load up front. And so if you put in $100,000 into a mutual fund, and you're going to start out with maybe 95 grand, right? Because you paid a load and they deducted the amount of that load as a commission, and you get nothing in return for that. With a MEC, you do pay a fee because you are buying a death benefit, but that death benefit is what you get in return, and it significantly increases the estate value of the money that you're putting into the contract, which I'll demonstrate in a couple moments. So the MEC and taxes. Bank CDs and money markets, well, they may incur a capital, they earn interest, right? And while the capital earns interest, if that interest is more than $600, you will get a 1099 to claim that interest earnings as income. When it comes to mutual funds and CDs and money markets, when you leave those money, when you have that lump sum money, if you leave any of it to your heirs, they're going to incur tax liabilities. So the difference is with MECs, the growth is tax deferred, unlike a bank CD, money markets, and in some cases, other investments that incur gains. Okay. The MEC grows as long as you don't touch it, and we'll talk about that in a few minutes, but it grows tax deferred. And the death benefit, which is going to be passed to your heirs, is going to be tax free. So if you had, let's say, $100,000 and you put it into a bank CD, and 10 years later it grew to $105,000, maybe, who knows, and you were to pass away, then all of that money, if you leave it to your heirs, all that money is going to create a tax liability for the party that receives it, the beneficiary of it. With regard to a MEC, though, it is a life insurance contract, and as such, there will not be a tax liability passed on to your heirs. Heck, sounds like a good idea to me. So what is the deal when it comes to MEC and the tax implications that has us oftentimes thinking that a MEC it's like we're demonizing it, like grab the torches and pitchforks sort of thing. It's really not that bad a plan, considering the alternatives and the circumstances that we're talking about. You see, a MEC is a life insurance contract, but it's different based on something called a GAAP term. GAAP stands for Generally Accepted Accounting Principles. And it's the difference between LIFO and FIFO. LIFO means last in, first out. FIFO means first in, first out. And with LIFO, what that means is that the interest gain comes out first, because if you put money into the contract and interest grows the total amount of the contract, or total amount of the value of that money, then what was the last amount of money that was added would be the gain. So that's essentially the difference between a MEC and a life insurance contract, because a life insurance contract is first in, first out, or FIFO, which means the first thing that comes out is the premium dollars. And that's why we're able to get around the tax loopholes that are created in this type of private family banking situation that we work with, is that when people start borrowing money out and taking it out, guess what? It's all first in, first out. They never touch the gain if they do it the way we teach. So there's never any tax implication. With a MEC, the difference between FIFO and LIFO means from the very moment they start taking money out, if there's a gain, then there's a tax implication. So here is what looks like the tabular detail of a $100,000 MEC on a 55-year-old. So you see here, we've got a guy who puts in $100,000, and at the end of the first year, he's got 96,000 and change that is projected to be the value. So the the fees involved for the death benefit are going to cost a few bucks. But in this case, the death benefit is over $162,000. So at the end of the first year, the 100 grand has grown in estate value by 62.837%. It's grown by 62,000 and change. So what does that mean? That means for in return for the fees, this individual would have increased his estate value significantly. All right, so now the money, as you can see, the net cash value continues to grow. So what happens if in year 5 he decides he wants to borrow or access $10,000 through the lending mechanism? Well, if he borrows that 10 grand, well, guess what? The value of the net cash value at that time is over the 100,000 he put into it. So the 10 grand that he would access would incur a tax liability at whatever his income tax rate is. So he would get from Lafayette Life, he would get a 1099 saying you have to claim this. And now this is where we oftentimes, I think the confusion lies, is that, you can borrow from these types of contracts and you don't have to pay it back. So what we're thinking is, what if we don't pay the loan back? You don't have to. But here's the key. Just because you don't pay the loan back doesn't mean you're not paying the taxes. Because regardless of whether you pay the loan back or not, you are going to have to pay whatever that you're going to have to claim that 10 grand if you borrowed it here 5 years later, and the total value's grown from 100 to 114 and change. You borrow $10,000, you're going to have to at least pay the tax the tax on that 10,000. So even though you don't pay the loan back, you're still paying back on the amount that the gain had equaled that you accessed. So what does that mean? So let's take a look and say, hey, you know what? 10 years down the road, there's 140,000 in change inside the contract. Well, let's say you borrowed 40,000 and you accessed 40,000 from there during through the lending mechanism. How much tax are you going to get taxed on? Well, back in year 5, when you borrowed the 10, you had received the 1099 from Lafayette. They adjust your basis to go up from 100 to 110,000. Or if you borrowed all 104, or if you borrowed 14,000, whatever gain you would receive the 1099 for, that amount increases the basis. So that when you come back, say in year 10, and let's say you had 140,000 in there and you wanted to borrow $40,000, how much tax or how much of a tax liability does that $40,000 carry? Well, it only carries 30 because you've already paid a tax on the original 10 that you took out, that you borrowed. So it's not a cumulative compounding amount. So if in year 10 you borrowed 40, then what you're doing is you're going to have the 10 from the original loan that you took out in year 5 added to the 30 that you're going to get a 1099 for the loan and that you took out as 40,000. They're going to send you a 1099 on the 30 because now at the time you take out this loan, your basis is 110. So now your basis is 140. So if you wanted to borrow money anytime later down the road, your basis is going to continually be adjusted upwards because even though you may not be paying back the loans, you will be paying the tax on whatever 1099 you receive. So each time in a MEC that you access funds and you're accessing the gain, you will receive the 1099. You're going to have to make that payment. And the Lafayette, the insurance company, will increase the basis every time, and they track this, so we won't have to worry about it. So let's say in year 12, you see here, year 12, it's 152,000. Well, if you borrow 20,000 here, you're only going to get charged a tax on, where'd my cursor go? On $12,000 or $12,521, because your basis now at this point is 140 from the two previous loans. Now, if you didn't take out any loans up until that point, and this is the first time you're taking a loan out against the policy, then anything up to 52,000 and change is going to be what the tax implication will, or the tax liability will carry. But as you take out loans throughout the process, whether or not you pay them back, you will be paying that tax. And every time you pay that tax, whatever that tax was, that associated gain increases the basis from which you're going to be borrowing against in the future or accessing in the future. And then when it comes to, in this case, the guy lives to the ripe old age of 80, and he's used up $200,000, paid whatever taxes were necessary throughout the process, and he graduated from this life to the next, the 95,000 and change, that passes to the heir, to the beneficiary, tax-free. If he never used any of these funds, let's say you got somebody who just wants to put the money aside, they want to keep it safe, they don't know if they're going to use it or not, and they never touch the money, then all 295, if assuming they pass or they pass away at age 80, all 295,000 and change goes to the beneficiary tax-free. So consider if you put that $100,000 into some form of a savings or investment plan, and it did grow over that period of time to $300,000, passing that along to, in probate with regard to, your estate, that's not going to have the same tax advantage. So this is why MECs with people who are in, have those certain circumstances, they have a lump sum of money. They want access to it soon, typically within the first 12 to 24 months, meaning we can structure lump sums to go into a contract with the premium deposit fund max to drip into that contract over a period of years to take that money and keep it from ever having these same tax implications. But if the individual looking for the contract wants to have access to the funds, then that might not be the right option for them. And again, if they're not planning on making ongoing payments, then a MEC is a good option. And I do want to point out, one more thing I forgot to point out here is that in year one, we've got year one up here. In the first year, year and change, okay, there is no gain. So into year two, it's not until the end of year two where there's $826 in gain. In the first year and a half or so, they can have access to the funds without any tax liability. I've actually helped some clients do this where they've liquidated a property and they wanted to put money into the MEC because they just wanted to let it sit, but they also wanted to have access to the funds in the first few years to pay off debt. They took out a big loan. There was no tax implication because they took out the loan prior to any gain. So now in that case, when they pay back the loan, the basis is still set at the original amount that they opened the contract with. Once they start making loan payments, or once I should say they start making tax payments on gains, that's when the basis is increased accordingly. All right, so that's what a MEC is for. That's how the tax implications work. Modified endowment contract is a great place for lump sums of money. You immediately increase the estate value of every dollar significantly, and you put those funds in as safe a place as possible while increasing the potential rate of return without the market risks that can really cost you. And every dollar in a modified endowment contract is available for banking. It really is a great option when the right circumstances exist. If you'd like to know more about how a modified endowment contract can help you protect large sums of money, or if you'd just like to talk about how you can start your own private family bank, just click the link and pick a time for us to talk. We'll help you make sure you are making the smartest decision you can make with your money.